Let's talk about the spread between the 10-year Treasury and 30-year fixed mortgage rates. Now, we've been hearing for years, or the pundits and the analysts tell us how the spread has been abnormally large, and that has been wider than historically average. I've disagreed with that opinion, by the way, and I'll tell you why. But what's more important, the spread is now the highest it's been in 40 years. That's right. As of last Friday, the interest rates on a 30-year fixed rate was 6.83, and the rate on a 10-year Treasury was 4.33. The 2.5-point spread, the highest it's been since 1986. And there's a whole bunch of reasons why. And let me get to the basis. The analysts that we've been listening to telling us about how if we just got back to that 150 basis point spread like we've had for the last 10 years, then gosh, interest rates would go down a full 3/4 of a point, right? That's what we've been hearing. And that's kind of a optimistic viewpoint, because what they're assuming is that we have the same market conditions that we have for the last 10 years, which was the last 10 years we had an improving interest rate market, right? Yields were improving, interest rates were going down, right? The risk associated with buying bonds was low. There was no inflation. The other thing is, which some of these analysts seem to forget, the U.S. government was the largest buyers of bonds, and so they were creating artificial demand, which pushed the price of the bonds down, right? But as soon as the Fed got out of the business of buying bonds, they got out of quantitative easing and they shifted into quantitative tightening. Then what happened is that it took market forces to establish what that spread should be. That is, if you were buying a bond today, how much premium do you want to get paid for the risk associated with a mortgage-backed security versus the low risk of a 10-year Treasury, right? And so what we're finding is that appetite for the mortgage-backed security today, investors gauge it to have a little bit more risk and want a little bit more premium, which why that spread is wider. It's really not hard to understand. And if you just go back to the great financial recession, where banks lost billions and billions of dollars on their MBS holdings, right? They have a little bit of scar tissue from that, and they're like, hey, look, I remember what it's like. I'm not going all in on mortgage-backed securities unless I get more yield. And then on top of it, you have foreign buyers of mortgage-backed securities. And as they get a little frustrated with some of those stances the United States is taking, they're like, I'm not going to buy your debt. I'm not going to buy your bonds, of course, unless you pay me more. And then I'll do it because it's good for me. So I'm using an article today. I'll show it to you. I'm using an article from Richter from Wolf Street. And man, I'm telling you, you have got to subscribe to this guy, because he not only does he put out stuff every day, but 3 or 4 times a week, he puts out critical information. And so you can see here in his article is like the title is "The Spread Between 10-Year Treasury Yields and Mortgage Rates is Historically Wide and Widening Further." Here are some thoughts, right? And in this article, he brings up a bunch of things, right? But in the article, what he says is, look, the Fed no longer is buying mortgage-backed securities. So now it's up to the market to decide its value. But at the same time, the Fed is buying treasuries, right? So the Fed is only letting $5 billion a month of treasuries run off. If more sell off than $5 billion, then they get back in the market and rebuy, right? They take new positions. So they're actually a significant buyer of treasuries today, and that's keeping the market a little bit artificially low than if the Fed wasn't a participant. On the other side of the QT, quantitative tightening, the Fed is not buying mortgage-backed securities. And so what it's done is it's really starting to control the shorter-term treasuries, but not the longer-term mortgage-backed securities, which is why you see this spread. You won't see the spread shrink unless the Fed gets back in and starts buying. Is that possible? Yeah, heck, that's possible. It was rumored last week that they might have to backstop the bond market because of all the noise going on with all these tariffs and new, economic policies. They almost had to come in and backstop it by buying treasuries. Now, they ended up not doing that, but they can always come back to the market. If the market gets disrupted, the Fed will, come and try to inject liquidity and control the economy. But I want to bet on that. Here's what I would bet on. You have to expect the spread between 10-year treasuries and 30-year fixed rates to be wider than what we're used to during our careers. They're going to be wider than they were the last 10 years. They're going to be 200 basis points or more. It's most likely 200 basis points to 225 basis points will be the spread going further. So what we have to caution against is telling our clients, look, the spread is abnormally high. It's at 250 basis points. If the market just normalizes and gets down to 175, we're going to refinance you for a half point right off the bat, regardless of the economic conditions. I would warn against saying that because I'm not so certain it's true. And I don't care how many self-serving analysts want to say it is so. I don't think so. So just as something else to pay attention to. Now, I really, really encourage you to subscribe to Richter. He writes such great stuff. It's easy to understand. Like I said, I've probably does 7 articles a week. I probably get something out of 4 or 5 of them. I love it. Check them out. I did a LinkedIn post on this today. Check out my LinkedIn. I repost a lot of Wolf Street stuff. Go there. You can always get hopefully valuable information. I have a link to the article on my LinkedIn, and I'm going to put a link to this article down below. I hope you got something out of this today. Hope you're a little bit more aware of what the market's doing. Those spreads are going to be really stubborn. They're going to stay high. That's going to be a little bit of a headwind to rates going down, which is not to say rates won't go down, but expect that spread to stay around 200, 225 basis points. Hope you're having a great day. I'll look forward to talking to you again soon. Thanks.